Good morning, everyone. You can hear me okay? Thumbs up? Brilliant. So today's panel, excellent title, A Famine for Private Equity and a Feast for Private Credit. As we have heard countless of times over the last day, we are in an incredibly volatile economic environment, which means some things that were hot are no longer the case, and areas that I would say maybe traditionally have been less exciting, like private credit, are gaining significant momentum. And I think the thing that we all need to start thinking about is, especially in the wave of today's sustainability backlash, we need to be creative about the opportunities that we are seeking to continue the momentum we need to see in the ESG space. And so today, I'm joined by a panel of esteemed guests who are going to take us through their learnings in the private equity space, but also really challenge our perspective on private credit and the opportunities that exist there, not only for kind of the average investor, but also those looking to channel capital to parts of the world that need it the most. So, just to keep you warmed up, and just for us to get a sense of the lay of the land, anybody who's actively investing in private credit today, can you just take a disc on the table and raise it? Okay, brilliant. And anybody who has been investing in private equity but has recently exited, can you raise your disc? Okay. With that lay of the land, I'm now going to give the floor first to Matt, but for each of our panelists, can you please, before you answer your question, introduce yourselves, the organization you represent, and kind of your vested interest in this topic. So Matt, I'm going to start with you. Can you please give us a lay of the land and tell us how your experience with private equity and private credit has been in recent years, in particular the trends that you've been seeing?
Thank you, Elizabeth. So Matt Christensen with Allianz Global Investors, based in Paris. And in terms of our panel discussion, so if we think about impact investing, I think many of us in the room probably started looking at this area from more the private equity space. If you look at the different data, you can see huge numbers relative to other areas of impact investing have really been in private equity traditionally. And that was a lot of the work that I did starting, let's say, 15 years ago. But what's interesting is to see how much that can change and how quickly it can change. And so to me, coming back even 5 years ago, private credit was one of these, I would say, Wild West areas when it comes to impact investing. And if I think about how much it's changed, it's incredible how quickly we can start to institutionalize, from an impact investing perspective, an area that previously was starting to get sort of like, well, that's ESG, that's impact, but no real rules. We still don't have great rules. We have more implicit understandings of what we mean by impact investing when it comes to private equity. And in terms of the debt side, it's traditionally been thought of as microfinance, blended finance, which I know was talked about yesterday. We can come to that. But on the developed markets, it was sort of a very forgotten or even underserved landscape. And when I think about the overall, if I look at the sort of stats in my head, private credit market in 2020 was roughly 1 trillion, 2024, 1.5, and they predict, this is Morgan Stanley information, up to 3 trillion in 2028. So obviously a huge area of growth. So that's already interesting. And what about impact inside that? Well, I think what's changed is when I look right now at research, if we think about what's happened in that space, and what I had not expected is how quickly just having a discussion would be such a demand from so many different investors on what can you do in private credit that might be impactful. That's where the conversation started roughly 3 or 4 years ago. And right now, if you think about, this is, I think, B Finance, if you look at, let's say, the 100 funds that I came across on this research, 46% of those are more or less energy transition infrastructure. Okay, so that's great on the debt side. But the direct lending side of that is roughly 40%, and the remainder, very small numbers, real estate. And this is sort of what we see happening now, is that 5 years ago did not exist. So this is a massive change, at least in my experience, on an area that you can see these, if you have a career long enough in the investment world, you get that moment where you see the door is open, let me just walk in, as opposed to trying to crack open a door on something that you think that you really have a great story, but there's just not enough interest. To me, that's private credit and impact investing. That's what I feel like I've been living through the last 5 years.
Brilliant, brilliant. And Dimple, actually, I'm going to give you the chance to build on what Matt has said, because while Matt's kind of early in his stage, you have been exploring the space for a lot longer. So can you please take us what you and Anthos have been doing and the learnings you have?
Sure. Hi, everyone. Dimple Sahni. I'm a managing director in Anthos. It's a family office and a values-based asset management firm, which actually has done a lot of work with the Vatican and faith-based investing. So thought the opening keynote was really interesting. Would have loved some Q&A, but I'll grab them during the break. So just to be a little provocative to what Matt said, we actually started our impact investing initiatives by focusing on private credit first and opportunistically add-on private equity. And let me tell you why. The family that I work with really loved microfinance. It's what they understood. They had heard about it. Many of them had invested in things like Kiva. So microfinance naturally lends itself to the private credit model inherently. So much of our portfolio when we first started was impact first, but also had 70 to 80% in private credit, with just a little bit of pop for private equity, because we were just dipping our toes in the private equity pool so that our group of stakeholders could understand what venture capital and private equity was. And we learned a lot from that. So financial inclusion in general, we broadened it to looking at from closed-end funds to looking at SME funds, semi-liquid funds. We looked at blended finance structures. So we really started there. And I'll share a little bit more about our successes and lessons learned later. But I think we started with private credit because we wanted the downside protection for the family, since they were just starting to wade into the impact pool. We said this is a great way for them to learn. It's supposed to protect you on the downside with a little bit of current income. So it's a model that was a little de-risked while we layered on equity risk a little bit later opportunistically. But it really started with financial inclusion and their appetite for that. And then we also were doing it in emerging markets from the go. So I think, again, microfinance lends itself to the developing world and the global south. So we thought we're taking enough risk on the emerging market side, enough illiquidity risk, sometimes currency risk. So let's start with an asset class that inherently is a little de-risked.
Now, we're going to come back to the emerging markets piece in particular in a moment. But we've got quite an interesting panel for you folks, because we've got a spectrum of experiences. We've got Dimple, who's very much been playing this space for a long time, Matt, who's entering it, Erwin. We're going to turn to you next, and kind of as an individual who's now looking and trying to understand how you come into this space and play. From your organization's perspective, how are you looking at private credit? What does the opportunity present to you? And how do you separate, using very layman's terms, the good from the bad?
Ooh, that's a very good question. Now I need to come up with a very good answer, I guess. So, my name is Erwin. I'm working for a Dutch pension fund, basically because Pete just tried to explain it a little bit. It's we call Pensioendiensten, which is basically a subsidiary of the pension fund, right? Anyway, so what have we been doing in that area? I mean, we've been investing in private equity for a while, right? And also in infrastructure, so we're a little bit over. I think it's like 1.5 maybe billion right now. Part of that is in impact. A little small part has been in really impactful strategies, which we would classify now as impact, right? But not at the time, because we weren't really doing impact. And a couple of years ago. And it's basically in line with what the previous, what was said in the previous session. It's like, okay, so we're excluding, and we got a couple of themes which are important for us, right? Usual suspects. It's climate transition. It's affordable food systems. It is biodiversity loss. And we were thinking, okay, we can exclude for the rest of our lives, but it doesn't really get us really far. So we also want to do something on the other side, right? So you get the engagement, but if you want to really start investing in solutions, you quickly end up on private markets. Mm-hmm. Right? And so we put together like a framework. We've been talking to a lot of colleagues. We've also been running around in the market, talking to asset managers, to consultants. We came up with a framework, and we came up also now with the idea of investing more in private debt, right? Besides all the other, let's say, private markets. But private debt is definitely very interesting. And basically fueled, basically what you said a second ago. There are a couple of themes out there, right, which are definitely feeding into private markets. So you get the ones that I just talked about, investing. It's not really that difficult, right? So the only thing you need to figure out is who is really into this game, for example, energy transition to make a real difference. So meaning you want to make and you want to put in place something which is profitable. And at the end of the day, also ensures that you get your impact. And there are lots of players out there. A couple of them are very opportunistic, right? As always, that's part of the game, right? So how do you go about actually scanning that market? I think it's just saw a little guy actually, like yay big, like 5 years or something. And I think, well, maybe that's a little bit how we should do it, right? When you talk to kids, you say, hey, do your homework, kid, right? That's basically it. And go and play with the other ones, right? It's a little the ecosystem that you got to think about. So play around with, for example, your colleagues, or there's a lot of people out there, a lot of research. You talked about Finance, but there are a couple of other companies out there. There's a lot of research out there, the Cambridge Institute, right? So there's a lot of information out there. A lot of people are willing to share information. So that was also one of the things that we used. And I think as a third one is when you learn to, when you learn to ride a bike, you don't have to go for like 200 kilometers immediately, right? You can use a couple of side wheels. You can start off easily and just build it up, right? And that's maybe also very smart because we're talking about private markets. So once you're in, it's pretty difficult to get out. Guys, you really have to do your homework and then look for, what was also said, I mean, we're also doing the same thing here. Huh? It's looking for culture and structure. Huh? So it's strong, you need experienced people, both in terms of sector. If you're going into energy solutions, make sure that the people on the other side really have some serious experience. Investing in that sector, and the other part is the impact side, right? How strongly is that actually embedded in the process? Do they truly measure and manage for impact, right? Or is it something that they just put on top of it and then said, looks great, let's try to sell that? And that just requires a lot of work. So, but that's how we go about doing that. Yeah.
Go for it.
Can I add 2 ideas on this one? The first is that I think part of the growth of it and the interest, aside from the classic things about the interest rate change and the fact that private equity didn't have a lot of exits, is the fact that because we had so many private equity funds already established in the market doing impact investing, that provided a tailwind in a way for having a mission-aligned approach where you could say the capital stack, you can now bring this debt instrument into an area from the sourcing of private equity funds that have already done this first initial tranche of investments, but they don't want to bring other equity investors in. They want to find now a new way to think about what's the next cycle of time in terms of the investment cycle with the actual, let's say, the company. I'll think about direct lending for the moment. And I think that's been very useful for trying to build out credible stories for the LPs around showing that impact can be done by already sourcing from a group of players that were already with the right mission and mindset. That's something that I think has been one of the reasons we see this growth, is that you're getting this base of let's say, 7 investors that already are speaking the similar language. One's equity, one's on the debt side. The second one, though, I think to your other point, is it's been critical to bring in an impact approach and make sure that it is fully integrated. And very quickly, one of the things that's really impressed me about meeting with limited partners like yourselves has been the sophistication of, and probably having been in impact investing for quite some time, that they're bringing now across all different investment classes in private markets. And so you don't get a break if they say, okay, it's credit, well, we'll give you some time. Actually, it's you might be training wheels. It might be newer to see the impact in this particular area, not emerging markets. I understand what Dimple's saying. But on developed markets, I think it is newer. But I'm happy to be challenged in this one. But you do not have the ability to say, it's new, give us some time on impact. You need to show up that you've really thought about this to be credible.
Maybe then we'll take the panel to emerging markets and provide that alternative perspective, because ultimately we need capital flowing to parts of the world that need it the most. And so Dimple, very keen to give you the floor here to bring that lens into the conversation, not only to highlight the different style of vehicles, but also give example of exciting things happening in this space, and maybe build off Matt's perspective as well. I'll give you the floor.
Yeah, absolutely. No, as I said, that's where our journey started. And I think, one, there's a lot of people, businesses that are clearly unbanked in emerging markets, right? So it was really filling a gap. And I think In emerging markets, you also have a lot of room for creativity because you're banking the unbanked. So in terms of the types of structures that we saw within private credit, impact covenants, revenue sharing, instruments which had some warrants and equity kickers built in. It just lent itself to different flavors of debt, which I think provides a lot of opportunity and options for the entrepreneurs or the fund managers to be able to deploy capital. But I think, people always look at the rates that you get sometimes in private credit and they think, oh, this looks really predatory. You're basically gouging people's eyes out for doing this. And I think the thing that we also have to debunk and demystify is that you have to look at the alternative. That's right. Either they can't get credit at all, or they're going to loan sharks or other people in the black market, and it's even more predatory. So I think, one, you have to be paid for your risk return, but you're actually doing, you're filling in a big gap there. And then I think we all discovered, certainly with microfinance, that the repayment rates were actually quite high. So the misperception of risk in emerging markets, even today, is I think, what's the word I'm looking for? Mispriced. So we've always had conviction behind emerging markets, even today when many of the people, maybe not in this audience, but in the world, are pulling away from, it's a risk-off environment, but emerging markets is part of that. I think it's a great opportunity to get into these markets because the valuations are lower. Again, the need is still there, certainly from an impact perspective, but we also looked at the demographic dividends of investing in these markets, the scale, the density. If you look at the purchasing power parity of the average citizen there, the businesses, the economic multiplier, the amplification effect of your impact per euro, if that's your unit metric, is just outsized from our opinion in emerging markets. So we've always had conviction behind it. And so even there are debt managers who have started out with US strategies. Some of them are in this room, and they've since launched EM strategies. We have helped them launch those strategies because, there's not a like-to-like comparison, but if you recognize pattern recognition between lending structures, SPVs, that have made you really intelligent about how things work, certainly in nearshoring in the US to Mexico or Latin America, you can port a lot of that learning into some parts of emerging markets as well. It's not without its risk, but I think we've always had conviction behind the impact theory of change in doing it that way. But the returns have also been very good in hard currency because we're doing hard currency. So we did a green bond in Brazil when no one was touching Brazil. And it was actually a hard currency where we earned net 11% USD in that. Because unfortunately, they couldn't find local real financing. So we were in that particular private credit instrument for 3 years until they were able to find local financing. So sometimes you're also just a bridge, which is great. And I think all of us, even in private credit, want people to graduate from our portfolios and either enter into the formal economy or get into the traditional banks where they're viewed as having real, authentic credit profiles.
Brilliant. And I'm actually now going to put Matt on the spot and just picking up on your point on, it's a time where people are pulling away. What justifies leaning in? Would love your perspective on the emerging markets piece.
So I'm not sure about the limited partners and asset owners in the room, but typically when I meet with our third-party clients and I ask, what is your allocation to emerging markets? If I'm lucky, it's 5%. I think we all have to start with a very sad reality about the allocations to that space in general of not families, this is a great thing, but of, let's say, institutional investors. It's wonderful if I hear higher numbers, it's very rare. And that is not even about impact investing. That's just emerging markets. So we always have to take a little bit of a humble pie moment of, wow, okay, of that allocation, I'm trying to get in on that one with something like blended finance, could be a great story about microfinance, et cetera. So that allocation piece has had a high set of inertia, has not changed very much. And when you have risk off, as you mentioned right now, Dimple, it's probably gotten even more tight. That would be my guess. So as an institution, the good news on my side where I sit, Allianz as an asset owner is highly committed to blended finance, which by default is also emerging market oriented. So we've put $4 billion to work in both emerging market debt as well as equity. so private instruments. And we've done that by working with different partners. What I can say is that we will continue to be following up with those strategies with other vintages, but this remains very challenging to get third-party investors to join us. And so they look at the de-risked idea, they see it, they find it interesting, but to have that partner to do that junior tranche, to do the de-risking and blended finance, takes a lot of work, and these are great partnerships, but to find the overlapping interest and then to explain it to third-party traditional investors is another piece of the obstacle that one has to go through in the sales cycle. So it has not gotten easier, it's gotten more institutionalized, so it's on the road, but it's slow. I wish it were faster.
Yeah, and just to dovetail off that, blended finance, there's been a lot of talk in the sessions, but also in the hallway chatter about there isn't enough blended finance, there should be more blended finance, and I think that's absolutely true. And how do you mainstream it a little bit? And I think it's in one way, it makes sense, it's so logical. You have different layers of risk capital, so you buy the piece that you're most comfortable with. Mm-hmm. But I think the challenge is that a lot of people forget what their role is in the capital markets. And now I'm going to just talk about some of the DFIs who also invest in emerging markets because that's part of their mandate. I have been in blended finance structures where I have sat in the mezzanine layer and the DFIs were sitting above me in the senior layer, and I looked up and I thought, what are you doing up there? You should be subsidizing my risk. You should be crowdsourcing me in. And I think instead of crowdsourcing in capital, they're crowdsourcing out private sector capital. So I think the blended finance structures are great in theory if people know and stay in their lane and know where they should be playing. Because I think, thank you. Wow, it's a great start to my day.
Honestly.
But so this is speaking to Matt's point. I think people they shirk the responsibility of the risk or they misprice the risk. But I think there's a lot of roles for different people to play in that layer cake. And I think there'd be more blended finance structures if people knew and did their fiduciary responsibility or actually did what they were expected to do.
Brilliant. I mean, it's hard to go after someone who's just been applauded, but Erwin,
No problem.
We'll come to you next. And I agree, yesterday there was a lot of excellent conversation around blended finance, and I think you cannot separate what's happening there with the geopolitical reality that we're up against today. And there was kind of thematic conversations around, we have less, we need to do more with less. And so I do want to bring this conversation now to today's rapidly evolving environment. And if we take a step back and look at the shifts in the last 2 months alone, although we're at the point where you almost have to check your phone hourly, even looking in the EU, looking at examples like the savings and investment harmonization, Germany's latest spending plan, all of these will have an influence on the private equity and private credit landscape. So I'm actually going to go to you, Erwin, first on this. How do you see this playing into thinking around these opportunities and asset classes?
Yeah. The thing was, if you look at emerging markets and blended finance, that started to look really well. I think is my personal opinion there, right? Because there was a study that came out end of last year by GEM, which was interesting, right? Because it's often about perception, a perception of risk and stuff like that. So these kind of studies are really welcome. If you look at the last, I think, was a study that covered 30 years or something, and that's really helpful to put things into perspective. Problem there was, so I think if nothing else would have changed, there would be a lot of interest, actually more interest than in the past. Now the thing is, things did change, right? And I think more than ever, there are a couple of they turn into security issues, right, for the EU, like defense. And I'm not saying that defense is like impact or something, right? But I mean, defense was suddenly kind of a big thing. You get energy transition, energy security has been a thing for a while, but now it's really going to the next level. So, and these things have to happen here in Europe. So, again, my personal opinion, I think that a lot of asset owners, right, like for example, pension funds, right, which have like their, it's not a constituency, but their participants which are living in Europe, right, might say, well, okay, you're right, if I would invest like €1 in an emerging country, that would have a huge impact. If I would have to invest €1 in Amsterdam, you don't even have an ice cream, right? So but nevertheless, on the other side, I can only kind of invest my euro once, right? So let's maybe think a little bit more close to home, go for these big strategic kind of themes in Europe. So I think that's going to be taking away a little bit, unfortunately, right, of the money that might have went more easily to emerging markets. That's a little bit how I would interpret it. On top of that, you get somebody running around who's saying that tariffs are the most beautiful word in the English language, right? And is apparently applying them. So that's also gonna shake up a little bit the economy. So I think everybody is going to go. A lot of countries, I think, and people are going to go more in a defense mode in the coming future. But I'm not a macroeconomist, so maybe maybe I'm seeing this completely wrong. But what do you think?
Well, I take on the positive, you mentioned the savings investment. I think that was 10 trillion. I think that's the numbers that the EU has been tossing around there that they want to get out of bank deposit accounts. Okay, great number. Let's see how it works. But if you can get that number into private capital, into other different types of asset classes, and not just sit earning no interest, that would be a wonderful thing. So good. At least they're tackling areas that can bring capital into Europe from Europeans to do things that would be more interesting in terms of investing, and I think would touch impact investing. On Germany, with the 500 billion, it's predicted that it's going to be 2x in terms of private investments. But it's also said, if you look at it, over 12 years. So I'm waiting to see how the numbers translate. I think inevitably where it is definitely true what you're saying, which is that we are now in a defense mode. On the other hand, I think perhaps I was in Brussels yesterday, and one thing I did hear, it was both Parliament and Commission representation that I was listening to. I've never seen them more feeling the need to go fast. So it will never be Elon Musk speed, which is good, but they are more willing to break things than they've been before, and perhaps a little bit of that is what we need to try to move things faster, which would benefit the financial markets and the single market particularly. Doesn't answer the emerging market one, so we're going way off piste at the moment, but at least it gives me some feeling of hope that on impact investing, developed markets, and Europe specifically, maybe we will have a little bit more of the engines of creation innovation happening here in these next 2 to 3 years.
Dimple, I'd like to give you a chance to build on that.
Yeah, I mean, we just invested in Eastern Europe, which fell under emerging markets criteria because, the war is still going on there. There's, again, a misperception of risk, we think, and a flight to safety. So, how are you defining Europe? And that's changing all the time. For those of you who had to apply for your ETA to now get into the UK. But anyway, so I think it depends. There are definitely places within Europe that you can still have outsized impact and do private credit. So the vehicle that we did was actually a structured note, which was ring-fenced towards green proceeds, funding banks in Eastern Europe that would then on-lend to green entrepreneurs. So you can find and pick your spots even within Europe. And I think we viewed it as a diversifier given the larger emerging market global south economies that we had. But I think this is a real opportunity for Europe. I think all of us live in Europe. I'm based in Amsterdam. We're a Dutch-based firm, but we have offices all over. And I think Europe needs to step up for itself and service its own citizens, certainly. Needs to go a lot faster. I think even Europeans would admit that there was a lot of complacency and maybe false sense of security, that they were buffered between these larger power players in the world. But I think, the natural DNA, I think, of Europeans is to do good for a society, right? A lot of them have very socialist mindsets, and it's about the greater good. And the whole idea of the EU is that all of these smaller countries would band together for the greater good in aggregate. So I think this is going to really test the whole EU model and what are we doing for our own regions, and that includes financing, because the euro versus the US dollar versus the pound, it's all going to be shaping up here in the next few minutes, or the next few years, sorry.
Could be a few minutes. The rate things are going.
But, we haven't talked a lot about the impact side of credit, and I wonder if maybe we could pivot to talk about that.
I was going to say, in the final few minutes, would be very keen to deep dive into that more, recognizing as well some of the things that you've picked up on, too, is the importance of timing and getting that right. So maybe actually, Dimple, I'll start with you and then move that back across the board. So really keen to tease out the impact piece of private credit and how you're embedding ESG thinking within that, recognizing that we do have a lot of learnings from private equity, both good and bad.
Yeah. I think I want to make a broad statement, which is you can have impact in every asset class. So we have a multi-asset approach. We do public equities, public fixed income, in addition to private credit, private equity, and real assets. So each asset class has its role to play in your strategic asset allocation, but also in your impact asset allocation, I would say. So I want to just talk about one example of private credit, which is when we were earlier in our incarnation, we were thinking about financial inclusion. We were trying different strategies with private credit. And one of our strategies was funding independent news media. We funded this tiny fund called Media Development Investment Fund. And I mean, it was really tiny, like $6 million tiny. Okay, this is when we were impact first. So we were trying to catalyze new things. And the premise of this fund was to lend working capital loans to free independent news media. That's radio, TV, news, print, web, mobile. In all over the world, but particularly in autocratic countries. So to give the citizen an independent voice. And we were 25% of this fund. So we went over our 20% limit typically, but we really felt like this is underinvested space and not everybody wants to do access to information. So one of our investees was this freedom of expression website in the Philippines called Rappler. And President Duarte took the CEO, Maria Ressa was the CEO. He threw her in jail. She was incarcerated because she had this, freedom of expression website where people could speak out against the government. This was in 2020, I think she was incarcerated. In 2021, she was on the cover of Time magazine, as basically kind of a freedom fighter. And I think in 2022, she was awarded the Nobel Peace Prize. And it was such an esoteric theory of change, and you're like, what change can access to information really have? I mean, can you topple governments? Can you change people's minds? Giving working capital loans to even print, newspapers. But we wanted to at least test the thesis. And for me, it really shows that even your smallest impact investments, certainly through private credit, can have some of the biggest outsized impact, because it led to something like a Nobel Peace Prize for this particular company, which then, really brought attention to not only what was happening in the Philippines, but what tiny companies like this could do clandestine. So that's an example of, I think, an impact that even something like working capital loans can have in the most esoteric of industries.
And recognizing that you're much further along the journey than these two, keen to get both your perspectives on how you are looking to frame impact via the investments and asset classes that you're looking at within the private debt space.
Okay. So, like you said, you can make impact all over the place, right? So, green bonds, very simple, been doing that for a while. Got to be a little bit careful that you also kind of apply strict rules to it, because there was also a lot of greenwashing going on. Listed equity, continue to find it a little bit difficult, although every investment has impact, so that's fine. If you look then at private markets, which are a huge part of the total economy, you probably got the figure in your head, but I don't. But so let's assume that's a big chunk. And that's finance, private equity, private debt, a little bit more private debt than private equity probably. So every firm which is kind of aligning there with or contributing to these transitions, right? Food transition, energy transition, you can come up with a couple of others, maybe. So these are all impact companies, right? They're services and products. They deliver impact, they deliver outcome. not all of them, but I mean a chunk. So there's a lot of stuff to be done there. There's much more. I think there also these ecosystems already exist, right? These big themes, they already exist. They're not new, right? So I'm not saying it's easy and just go about and just take them off the shelf. You do have to do your homework, but I definitely believe there's a lot to be done in those areas to get them. Because I mean, often the listed companies are kind of they got their quarterly kind of cycle, right? Ooh, gotta present our profits, and that's fine. That's how the game is played. But I mean, it also prevents them often from let's say really investing into more resource efficient production processes or whatever, right? They might do it, but a little bit they might be a little bit hesitant. And what you see, another research thing that came out, I think was Boston Consulting or something, right? They said, oh, we compared a little bit listed with non-listed. What you see is that non-listed companies, they tend to invest a little bit quicker and more into that resource efficiency part. It's not like 80% or something, it's like 10 or 15% more, which is kind of interesting. That's because they get a little bit more time, right? Not everybody's breathing up their neck every quarter to show beautiful results. So yeah, I hope that's kind of an answer to your question. So I see a lot of opportunities. Yeah.
Lots of opportunities, and recognizing that we're coming to the end of our session, I want to give you the floor, Matt, but please maybe as part of your answer as well, looking at the group that we have here, practical considerations around next steps too. If there's one thing that we want to ask the room, and I also feel free to jump in, the two of you, if there's anything else.
So I'll do short answer on the first question and then give the takeaway. On the first part of it, I'll stick to private markets. Having a robust impact framework is critical. It's the credible component that you need to have, that you really connect it into your investment process. That's the base. Everyone always says it. You always need to show proof. And for us, that's going to be looking at the investor contribution as much as it is the actual company and the impact itself of what the company is looking to do, theories of change, products and services, et cetera. That's just a base level. And then in terms of what we're doing on that private credit, I'm really excited by what we're finding that are impact-oriented deals that we can show the impact of them, whether it be biological control over pesticides, a change that makes money, but also is a step change in terms of innovation. It's a loan instrument that we're doing around that. Looking at waste management, there's quite a few different areas. And I'll take that now to another area that we're working on, which is about how to define the energy transition in private markets. We're starting with infrastructure, and we're laying that out because there's so many different questions about where do data centers sit? And what we're doing is putting together a schematic about defining that, because we think there's not a definition in the market. And we want to go and say, this is what we stand for about energy transition. We'll use a broad swath of private markets and talk about what's business as usual, more the sort of transition and more impact. And we do think that there's still defining that's needed, a definitional landscape to help our clients and even regulators who are asking for this kind of work. And then I would say to your question, trying to see how to make sure that the stories that you put together, whether they be highly compelling ones, I love the one you just mentioned, Dimple, or more standard ones that investors say, okay, but I see that it's impact while you're making money. That's what institutionalizes and mainstreams this. And you just have to try to get it simpler and standardized. And part of this is to create standards of measurement over time. And I think that we're still getting there, but we're not done. And I want to get there as fast as possible on the private markets to influence the regulation.
And on that note, I'm going to pick up on one thing that Dimple said, which is it's in the nature of Europe's DNA. And I thought that was a beautiful phrase because the theme of this conference is the new DNA of institutional investments. And so as you leave this room today, and especially as you head into your Investor Connects, what are you going to be baking in as part of your new muscle memory around how we create impact? You've had examples today of how that manifests in the private credit space. Reach out to these individuals. They're keen to connect. They're keen to share their experiences, because collaboration is the thing that's also going to underpin the great unlock behind the opportunities we've spoken about today. And so on that note, yes, sir, thank you. Thank you very much.